Well, good morning and welcome to our webinar this morning on some of the Canadian-US cross-border tax issues with respect to the Canadian budget that was released last week. With me today is Philip Mei, a director in our Calgary office.
Thanks for the introduction, Steve, and welcome everyone to our webinar today.
Excellent, thank you, Philip. And it'll be a little bit of a different webinar today. We're probably going to have a little less time that we spend on some of the material. Normally our webinars are anywhere from 45 to 60 minutes. We're a little bit condensed this time. We'll probably go to 30, 45 minutes. We're going to allow time for questions at the end of the session here. So if you've got questions, you should click on the box in the lower right there. It says question and answers, and Gina Min and Shan Liu, who are managers in our office, are going to feed those questions to us at the end. As always, we have a survey we'd love you to complete. We always look for new ideas and some feedback on these sessions, so please take the time afterwards. You'll get an email with that survey and let us know your thoughts. And if you want to actually see the text of today's presentation, you can click on the live transcript box below and you'll be able to see what we're saying. Let's talk about the three different items that we're going to try and cover in our time this morning. So we're going to talk a bit about some of the measures that were introduced to try and minimize, curb, or eliminate speculation on housing and residential properties in Canada. We'll also talk about the incentive programs that were both announced in the budget and beforehand, and how that's going to try and encourage Canadians to buy that first home. And the last thing we'll talk about is how we're going to try, how the Canadian federal government is going to try and stop, cease, and end some of the tax deferral programs that families were using in their private companies. So we'll talk a bit about that as well. One of the things that we introduced last Thursday in the budget was something that's trying to address the problem with high housing prices, with growing difficulties that Canadians are having at buying residential property. And one of the concerns is on speculation on housing, whether it's foreign buyers, whether it's Canadian buyers who are flipping houses. And so effective in 2023, and we'll talk about that date in a little bit, to the extent that an individual buys a recreational property or residential property that is held less than 12 months, then a couple things are going to happen. One, there would not be any principal residence exemption available for that. And so the principal exemption in Canada, if it's your principal residence and it qualifies, in general terms, gains are tax-free for Canadian tax purposes. Now what will happen is you have to hold that property at least 12 months in order to qualify for the principal residence exemption. If you don't hold it for more than 12 months, ordinary tax rates are going to apply to that gain. And so to the extent that you've got a gain on that property, those tax rates can be as high as 53.5% in British Columbia or 48% in Alberta. That's twice as high as the capital gains tax rate. There are some exceptions for this rule. If you're into situations where you change jobs, whether you have, if you have a child, need to move properties, if there's a divorce or any other kind of personal situation that would qualify, those will give you exceptions to these high rates of tax. Despite those exceptions, you still have to be mindful of existing Canadian tax law that could characterize something that's capital gain as ordinary income, depending on your experience as a real estate investor, the frequency of your trades. So from a US perspective, US citizens and residents will be familiar with that 12-month because it's very similar to something called the short-term capital gains rates. In general terms in the US, if US citizens or US residents have capital property that they sell in less than 12 months, it's not subject to the lower long-term capital gains rates. It's subject to something called a short-term capital gain rate, and those rates could be as high as 37% under US federal law. To the extent that you're subject to these higher rates in Canada under these speculation rules, you'd get a foreign tax credit if you're a US citizen. And so you'd probably offset that 37% rate. And to the extent you've got an excess of Canadian tax over the amount of US tax, you'd get what's called a foreign tax credit carryover, or you could use those excess credits against other non-US source income. We also anticipate that for sellers, for non-residents of Canada that are selling property, if it's held less than 12 months, the withholding tax on closing could be much higher. Currently, when a non-resident of Canada sells Canadian real property, there's a withholding tax of 25% of the gross purchase price, and that's withheld on the day of closing by the purchaser. Generally, to the extent that 25% is usually higher than the actual capital gains tax, at least Canada is collecting more money up front when the closing. Now that the tax rate is potentially twice as high, we anticipate that withholding tax rate for non-resident sellers could be as well as much as 50% of the purchase price. In addition to some of those measures, there's been some updates to vacancy taxes. These weren't necessarily announced on Thursday, but it's important to summarize what some of those changes are that have been over the last while. So for non-Canadian or Canadian buyers of Canadian residential property, under federal law, and this was enacted, and this was proposed in the budget last year in 2021. It is still legislation that's being subject to consideration and debate, and eventually we expect will be passed. And when it is passed, it's going to be retroactive to the first of the year. And effectively, there's a 1% tax for non-resident, non-Canadian buyers of Canadian residential property if they either don't rent it out for more than 6 months of the year, or if they don't use it as their own primary residence. The rules are somewhat similar to what's been in existence in British Columbia. So for example, the province of British Columbia in certain areas has a speculation and vacancy tax of up to 2% of the value of the assessed value of the property. If it's not either used as their primary residence or not rented out for more than 6 months. And those areas are anywhere from the Greater Vancouver district to Victoria to the Okanagan. There's about 4 or 5 different places around the province. In addition to that, the city of Vancouver, so different from the province, but the city of Vancouver has an empty homes tax of up to 3% of the assessed value for those similar reasons. And so when you add these things up, if you're subject to all of them, it could be a 6% annual charge on that property if you're not using it or renting it out, not using it for your principal residence or renting it out.
So given the high price in the Vancouver real estate, that 6% could be really significant then.
Well, I think it is. And we've seen some of our clients make changes to how they operate because they'll either try and rent it out and reap those rules, or we've had a few sell and just say, okay, well, this is to the point where this is, we could rent a property and be much cheaper, and then it's someone else's problem. So, the city of Toronto has been watching this. Other cities around North America are watching how Vancouver's reacting to property taxes, to property usage. Pardon me. City of Toronto has passed legislation in late December last year, where starting in January there's a 1% tax on an annual basis, for the same reason that we have in Vancouver and British Columbia. If you don't use the home as your primary home, or if you don't rent it out more than 6 months, you'd be subject to a 1% tax. The city of Vancouver's had this legislation for about 3 or 4 years, and it has changed some of the rules. And, recently in February, they relaxed some of the rules for individuals who own home, but if they're in a healthcare situation, if they're in a facility, if they're you can't use their home or occupy it as their primary residence. It used to be that they've got 2 years that they could basically get a holiday or an exemption from the City of Vancouver empty homes tax. Now that extension can be as high as 4 years. So as the rules, as the time goes on, the rules change and they evolve. Philip, you want to talk a bit about some of the other rules that are here for purchasing homes?
Yeah, for sure. So similar as those vacancy tax apply against non-Canadian purchasers. Also, the province of British Columbia on Ontario also charge about 20%, actually 20% of tax whenever a non-Canadian buyer is buying a Canadian real property. That tax was charged on the transaction whenever the property is closed. For British Columbia, the 20% was applicable for real estate in selected area, including the Greater Vancouver area, Victoria, or certain area in the Okanagan. For the province of Ontario, the 20% was actually increased this year from 15% previously, and it applies to the entire province. So any non-Canadian buyer buy any property in Ontario, they would be subject to a one-time 20% tax on the value of the property. The non-Canadian buyer includes a foreign person, a foreign corporation, certain taxable trustee that is for the benefit of a foreign individual. So the criteria for those taxes is quite broad, and it catch a lot of potential buyers. And then also for the federal level for this budget, the federal government actually expressed the intention of make a purchase from a foreign buyer is actually illegal. So no purchase is allowed for up to 2 years of period. And there was certain exception to the limitation. Certain foreign student could potentially buy a real property in Canada while they are studying in Canada. We have no clear idea on when this law would be effective right now. So in the case that any potential foreign buyer that is getting close on buying a real property and they don't mind paying that 20% tax in case they're buying from British Columbia or Ontario, they should rather close that the transaction as early as they can, or they could probably have to assume some of the risk that the federal government may actually come up with the law or enact the law at any time, so they might not have enough time to close the transaction. So there was some of the risks they have to be aware of, and they have to consult both the legal advice and accounting or tax advice before any transaction happens.
And Philip, it's one of those things we've seen from time to time over the last few years with these higher foreign buyers taxes, that as families immigrate from the US to Canada, particularly where their immigration status is a bit uncertain, as they move from kind of landed immigrant status to permanent resident status in Canada, they can get caught in these transactions, these transitions, if at the same time they're trying to purchase a property in some of these affected areas. The first step we're going to have to make sure of is they're going to have to make sure that they can actually buy that property under federal law.
Yes.
All the details are coming in. Then, as you say, if they can buy that property under federal law, now we've got to consider in Ontario, British Columbia, how is this foreign taxpayer going to apply? There are certain exceptions depending on your immigration status that you might qualify under some profession. There are some certain immigration groups that you can qualify to get exemptions for this. You can also, in certain circumstances, in British Columbia at least, pay the tax, and then as long as you can get your immigration status within a certain period of time after the purchase, you can get a refund. So there's a lot of steps here you've got to go through to first be allowed to buy the property, and then to try and reduce, if not eliminate, some of these provincial foreign buyers tax.
Yeah, so I think general advice would be clear about your immigration status. Make sure that you consult with the proper legal and tax advice to make sure that you are allowed to buy the property. And if you do, then you have to go through to see whether you are able to fit into one of those exceptions for the province of British Columbia and Ontario, and to see whether you would be qualified or to get away from the 20% tax. If not, then that's basically added to the transactional cost, right? So you have to consider that whenever the taxpayer is buying a real property in Canada. So Steve, just move on to the next slide.
Sure, there you go.
So on one hand, the Canadian government tried to limit the ability of foreign buyers buying real property. And at the same time, they try to offer help for local Canadian residents to buy their homes. So a lot of the measure that introduced was targeting the first-time home buyer. So the bigger topics related to the budget is they introduced something called a tax-free first home saving account. So a taxpayer could contribute up to $40,000 to this account and claim a tax deduction on their tax returns. So essentially, the taxpayer could contribute pre-tax money into the account. So any growth inside of those accounts is tax-free. The same for withdrawal. Whenever the money is withdrawn for this account, that is not subject to tax. So essentially, the taxpayer could enjoy a tax-free growth of up to $40,000. So for a married couple, the the contribution is up to $80,000, and then you have also count the growth between the contribution and the ultimate withdrawal. The government is working with the financial institution to make sure that taxpayer could start opening and contributing to those accounts starting in 2023, so next year. So for the taxpayer that happen to be also a U.S. citizen or U.S. green card holder that is subject to U.S. tax, any type of registered account could potentially subject for a different treatment when you're looking for a U.S. tax purpose. So based on the past experience and some similarity to RSP or TFSA, the tax-free saving account, we don't believe any of those contribution to the tax-free first home saving account is deductible. And the income or the growth inside of those accounts is not tax-free for US purpose. It means that any investment income or capital gain that you earn inside of those accounts is taxable for US tax purpose. And also potentially that the tax-free first home saving account could be subject to additional filing requirements for US tax purpose. Some of the more common requirement would be a foreign bank account report once your non-US account aggregated highest balance is over $10,000. The account balance would be reportable on an annual basis for the Department of Treasury. And then in case that the tax-free first home saving account held any non-US mutual fund, exchange traded funds, etc., that they are likely a PFIC as well, as discussed in some of our earlier webinar that we had before. So once the investment could be considered as a PFIC, a passive foreign investment company, then the additional requirement of disclosure is also required. And in terms of trust disclosure, because in our initial review, this type of account is really similar to a tax-free saving account when the taxpayer is being the trustee beneficiary at the same time and then he's making all the investment decision for his own benefit. We don't believe there was actually a trust fiduciary kind of a relationship within the agreement. So in our opinion, likely the tax-free first home saving account is not going to be a trust for US tax purpose. So we are not, the taxpayer should not likely have any trust disclosure requirements for the US tax purpose. So as stated a little bit earlier, that since all the investment income is subject to US tax inside of those accounts, the taxpayer should really consider like how they could use some of the foreign tax credit to offset some of those US tax on those investment income. We don't want a taxpayer to ending up in a situation that they achieve a tax advantage on their Canadian tax return by contributing to this account and earn a lot of investment income. But on the other hand, the same income is subject to US taxation, and they actually don't have any foreign tax credit to offset any of the US tax otherwise payable on the investment income. So ideally, we want to make sure that the taxpayer have appropriate planning, what kind of investment to be held inside of the account. In case there was any significant income triggering event, we want to plan ahead to make sure that there was enough Canadian tax pay on other similar investment income to offset other offset the US tax payable. So ending up in a situation that make sure the taxpayer is not saving Canadian tax, but ending up paying US tax. We want to achieve an overall tax saving for the combined tax in both in Canada and US.
So I think what I'm hearing, Philip, is, there are some US reporting requirements and maybe some modeling or some strategy you got to look for. But for a US citizen, and take a US citizen couple who are in Canada trying to buy that first property, if they can reduce their Canadian tax by putting, say, $80,000 into a plan, and if their tax rate's 50%, they get a $40,000 reduction of their Canadian tax. And if we can manage some of the US reporting and some of the US tax on the income, this sounds like a pretty attractive way to help buy that first property.
Steve, I would agree that general comments due to the fact that in most common case scenario that the Canadian tax is actually much higher than the US tax. So even though the 80,000 contribution for a married couple is a tax deduction and reducing the Canadian tax payable. But after the deduction, the Canadian tax is still likely higher than the US tax otherwise payable. So with the appropriate planning and then be aware of the additional reporting requirement, I definitely do feel like this type of account would be great help for the first-time home buyer to save up for their down payment for the first home in Canada.
Excellent. Philip, you're going to tell us about some other initiatives or credits that can help.
Yeah. So other than the first-time home buyer tax saving accounts, the federal government also either introduced new tax credit or doubling some of the existing tax credit related to home buyers. So the first one is the first-time home buyer tax credit. So in Canada, any taxpayer that bought their first home within the tax year, they're allowed to claim a tax credit to offset the tax they otherwise is payable. So originally, this first-time home buyer tax credit is up to about $750 of tax credit. Assuming your tax liability is otherwise higher than that amount, you would see a full reduction of the $750 from your tax bill. Now, the federal government actually doubling this first-time home buyer tax credit to $1,500. So for a married couple, if they share the interest in the home, they could get a tax credit up to $3,000 combined. The next credit is new and introduced in the federal budget last week. It's called multi-generational home renovation tax credit. The government realizing that the housing market is pretty unaffordable for a lot of new families, and a lot of families choose actually to live with their extended family. That in a lot of cases, there was more than one generation staying in the same home. So they're introducing this particular tax credit to kind of encouraging taxpayer to include like to spend renovation costs to try to build a second legal suite for the different generation to live in, either your parents or your child's. So this particular tax credit, you have to spend the money to renovate and try to build a second suite. Up to $50,000 of the expense could get a tax credit of about 15% of 15% on the $50,000 up to $7,500 tax credit. Similar to other non-refundable tax credit, as long as your tax liability is higher than $7,500 for that particular year, you would see a reduction of the whole $7,500 from your final tax payable. And then the third one is home accessibility tax credit. This is a current tax credit. So the federal budget just doubled this credit for the future years. Similar to the second one, for this particular credit, the taxpayer have to spend expense to renovate their home to make sure that the home is accessible for disability reasons. Now you could claim a credit up to $20,000, and 15% of the $20,000 works out to be about $3,000 of tax credit. And then the next one is first-time home buyer incentive. This one, it was actually announced before the budget. It's a similar approach to try to help first-time home buyer and then for certain income earners to kind of afford their mortgage. This is actually a little bit different than a tax credit. Is the taxpayer could actually borrow up to 5 to 10%, depending on 5 to 10% from the federal government, depending on the property that they are acquiring. So in case that a married couple try to buy a new build property, they could allow to claim 10% of the property value from the federal government, assuming they meet all the criteria regarding both income and then the mortgage size comparing to their income. So for general areas around Canada, the couple could have a mortgage up to 4 times of their income. For certain areas like Vancouver, Toronto, they could be up to 4.5 times of their income for the mortgage size. So what happened is, let's assume, using an example, that a married couple is buying a $500,000 property, a new build property, and they could get a 10% loan from the federal government. So they end up getting $50,000 loan from the federal government, and they only need to get to pay the remaining $450,000. The loan from the federal government actually translated into a 10% ownership by the federal government at the same time. So the taxpayer would have to repay the loan either within the 25-year period or whenever they dispose the property eventually. So using that same example, let's assume the couples dispose it in 5 years for $800,000. Since now the federal government owns 10% interest in the property, they would actually have to repay the $80,000 to the federal government, and they keep the remaining $720,000 from the proceeds as a disposition of the home.
So it's as if they've got a partner, like a silent partner behind them that's taking some sort of share of the up and down of the value, and they take the risk reward, the federal government does.
Yeah, totally. And then it also works on the other side as well. In case your property value drops from when you first originally acquire it, you are still going to be responsible for 10% of the value. So basically, you're sharing that ownership with the federal government on a tax-free, on an interest-free basis. The federal government is not charging any interest for that loan. So instead of owning 100% of the home that you just bought, you just own 90% of it, but you're still going to enjoy it on the same basis as any other home that is 100% owned. And the federal government will just want their own 10% back whenever you dispose it or within the 25-year period for the repayment.
So you get 90% of the ownership, but 100% of the square footage. In other words, you don't need to leave a room in the house for a federal government employee to come and work part-time out of the house. It's all yours.
Yeah, I'm sure that the federal government doesn't want to share the room with other taxpayers. So that's some of the tax credits, mostly targeting first-time home buyers in Canada. So for the U.S. tax implication, that we do expect the U.S. tax follow kind of the same treatment for Canadian tax purpose. And most of those tax credit is a non-refundable tax credit. They are not a taxable benefit for Canadian tax purpose. So we expect that the U.S. will follow the same, that treating them as a tax-free benefit. One thing to keep in mind is because the taxpayer, if they are claiming any of those tax credit, they are reducing the Canadian tax payable on their worldwide income. We would have to make sure that they would still have enough Canadian tax pay on their Canadian source income to make sure that they are not subject to US tax on the Canadian source income. So essentially making sure that after the tax credit, whatever tax credit they claim, the Canadian tax rate is still higher than the US tax. If not, then we have to look into if there is any foreign tax credit could be carried over or carried back on the US tax return. Similar theme as the previous slide, that we just want to make sure the taxpayer, when they're utilizing all this tax credit, they are not subject to a adverse result on their US tax returns.
So for a US citizen family, if they're in Canada trying to buy that first home, they really don't have to do much from a US perspective for a lot of these credits and programs. There's no extra filing requirements. There's no extra disclosure.
No, this basically, the tax credit was just calculated as a part of the Canadian tax return, and it just reduced the Canadian tax otherwise payable directly. The only catch is, just like I mentioned previously, is just make sure that the Canadian tax was not going too low, that is lower than the US tax otherwise payable. Otherwise, you're basically getting a credit from the Canadian government, and then give it back to the US government.
Excellent. We'll shift gears a little bit here for our final topic, which is the impact on private corporations and what some of the measures have done to end or eliminate some of the deferral strategies. And I think it's important here just to explain what was happening before the budget, because if you, and you need to understand Canadian taxation of passive income being interest or dividends or royalties or rents or anything that's of a passive nature. So in general terms, depending on the province that an individual lives in, that tax rate can be anywhere from kind of 48% to 55% actually to people in Ontario. So a fairly high rate of tax. And Canada's got a tax integrated system so that regardless of whether you earn that passive income personally or through a Canadian corporation that you might own, the tax rates are roughly the same. There's a bit of a higher rate when you earn that passive income in a Canadian corporation. It can be as high as from 52 to 58%, but the idea is that the rates are fairly similar. And more importantly, that in general terms, you can't really defer or delay any of the taxation by having it in a corporation. We love using Canadian corporations when we have our active businesses because the first $500,000 of profits is taxed at a really low rate, and then the next, profits on active businesses is taxed at a rate as high as 27%. So we kind of go from 11 to 27% depending on the province. But that's for active business income. There's a refundable tax mechanism that is probably far too involved to explain in the limited time we have. But effectively what happens is in a corporation, in general terms, there's a refundable tax that drives the tax rate on passive income to that 52 to 58% until you take the money out of the corporation, and then you get a refund of the corporation, you pay tax personally, but effectively eliminates the deferral. What was happening before some of these budget changes last week were two different strategies where Canadian families were using either a non-Canadian corporation, could be a US corporation, could be something overseas, but having the mind and management or having the decisions being made in Canada. So it made it a Canadian resident corporation, but it couldn't be a Canadian controlled private corporation, and therefore wouldn't be subject to this refundable tax and this deferral, and there'd be a deferral opportunity. The other strategy was for a family to own a Canadian controlled private corporation, but then it would own a subsidiary in another country. For example, it could be a controlled foreign affiliate or a wholly owned US corporation. And that US corporation or that non-Canadian corporation that's the foreign affiliate, it was the one earning passive income. And if you chose certain countries in a certain way, and in the US, when in 2018, when the federal government in the US lowered the corporate tax rate from 35% to 21%, this enabled families to use US corporations to earn passive income, pay that 21% tax rate. And when you went through the mechanisms in Canada, you didn't pay this refundable tax. And so as a result, you could pay current tax on passive income of anywhere from kind of 24 to 28%, but you delay the taxation of that remaining, 26 to 28 to 30% until you took the money out as an individual shareholder. And if you were prepared to leave the money in either company for some time, you could get this long-term deferral, very attractive. So there were a lot of stories and rumors about finances anger over these strategies. They were aware of them. There was a court case that was running through trying to challenge this under general anti-avoidance regulations. Finance decided to end this or try to end this as much as they could. So they have two different ways they're going to end this. Philip is going to talk a bit about the first one.
So yeah, the first one was adjusting the first strategy that the taxpayer used to defer the refundable tax by introducing something called a non-CCPC, Canadian Controlled Private Corporation. So they're introducing a term called substantive CCPC. So in case of any private corporation that is not already a CCPC to begin with, they would be a substantive CCPC in case they are controlled by a Canadian residents, directly, indirectly, and by whatever manners. So essentially, as long as the private corporation is controlled by a Canadian resident, Canadian corporation, they would be a substantive CCPC, or they would be a CCPC. So they try to expand the concept of CCPC to begin with. Then also includes corporation or private corporation that where non-resident has right to acquire shares. Previously, the definition of a Canadian controlled private corporation, whenever you decided the control, they actually have to consider the option to acquire shares as well. So in case that you have a group of people, or the Canadian owning 50 shares or 100 shares of a Canadian corporation, but at the same time, you have a non-Canadian having an option to acquire that 100 shares from those Canadian shareholders, that would actually make the corporation not a CCPC, because from the tax laws perspective, you would have to consider all the option that is, you would assume that the option would be exercised whenever you try to determine the CCPC status. Essentially, the introduction of this definition is try to make sure that all the private corporation that is somehow somewhat is controlled by Canadian residents, individual corporations, they would be under the same umbrella, and then they would be subject to the normal passive income, the refundable tax on it. So anytime that you have a substantive CCPC and then you earn investment income, those investment income would be subject to the same refundable tax as the same way as a CCPC does. So by doing that, any non-CCPC previously that is controlled by Canadian, at the time that they earn the investment income, they would have to pay the 52 and 58% tax depending on the province in the year earning the investment income. So they lost the ability to defer the refundable tax. So essentially, any shareholder of a substantive CCPC, you could pretty much consider it as the same tax treatment as if they are a CCPC after the budget day. This rule applies for tax years ending on and after April 2022. There were some certain exceptions in case like your CCP, your corporation is already entering into a sales of business, or that you already enter into an arm's length agreement to sell certain properties, then you would be able to still utilize it for the year ending after. So you would be still able to use it for the tax year of 2022. For any other corporation or the newly incorporated corporation, you're no longer able to use the non-CCPC strategy to defer the tax anymore. So for existing non-CCPC, that you would be still able to use this strategy to defer the tax up to the tax year ending before the budget date. So for your 2021 tax year, if you already have that structure in place, you would not be subject to this refundable tax for the last year of 2021. And starting on 2022, unfortunately, the taxpayer or the corporation will be subject to the refundable tax, essentially eliminated any possibility of deferring refundable tax.
Excellent, Philip. The other strategy, the other change the budget introduced last week was to change the taxation on controlled foreign affiliates, and in particular, modifications to the calculations. And this could be its own webinar. And looking at the time here and how much time we have left, I'm not going to go into the details other than when a controlled foreign affiliate earns passive income, that income has a term to it. It's called foreign accrual property income, and it effectively gets taxed currently to that Canadian corporation. But the rules in Canada allow for what's called a foreign tax deduction, foreign tax credit. They're contemplating the fact that you're going to pay some, in let's say the case of a Canadian corporation that owns a US corporation, you're going to pay some US federal and perhaps state income tax on that passive income. Canada is going to grant you effectively a foreign tax credit for that. Under previous law, that foreign tax credit and the way it's been structured has allowed this deferral to happen for a number of years. The way Canada is now going to treat this is they're going to effectively reduce the amount of foreign tax credit you claim. They're going to make other adjustments to integration. So effectively, the combined US and Canadian tax rate on passive income will get up to that 54 to 58% until such time as you pay out dividends to yourself personally. In the end, you're going to eliminate that deferral. And same as what Philip described, it's effective for 2022. So that deferral really ends last year. So a couple of major changes and some reactions to what finance in Canada have been concerned about on families trying to defer tax. Those seem to be dramatically eliminated. We'll see if any additional ideas kind of emerge from all of these changes. That ends the formal part of our webinar today. We thank you so much for spending the time today to hear some of the changes. Again, we remind you to complete the survey that will be sent out to give us any kind of future ideas. The budget was an all-encompassing document, as it always is. We just chose to focus on certain items on it that we thought had some interest to people in a cross-border tax situation. There's a whole bunch of more changes in those budget, and we encourage you to read through those. If we have any questions, and I haven't checked with Shannon or Gina, if there's questions, we'd be happy to take a few at this time.
Yes, we've got a few questions about the eligibility of the tax-free home savings account. And one of them is, would the tax-free home savings account apply to individuals that are divorced and effectively have to start over and save for a new home?
So the question is whether they'd apply to a divorced couple. And Philip, I'm not sure whether, I mean, the key I think is that plan is it has to be a first time purchase. Is that correct?
I believe that's the case. I would have to actually review the more detailed rules to decide whether they would be eligible for not. Like Steve said, a lot of those measures targeting first-time home buyer. So in case that the divorce taxpayer, they never on title for, let's say, the previous married home, or then they are likely be qualified as well. In the case that they were on title of it, we would have to decide whether there was some exception underlying in those rules that would actually allows the divorced couple to save up for another home again.
So the answer is we're not sure. We think there may be some eligibility. We'll have to get back to you on that. Other questions?
Yes. Can you expand more on the plan that you mentioned for US citizens to use the $40,000 of first home savings account to offset the US taxes?
Right. And so Philip discussed that plan in some detail, and let me kind of capture it. For US citizens, neither the tax-free savings account, which has existed for 10 or 15 years, well, since 13 years now,
yep,
nor this new first-time home buyers account, neither one of these are going to be tax deferred for US federal income tax purposes. You put money in the plan, it earns interest or dividends or whatever it is, it's going to be subject to US federal income tax. So one of the strategies we think US citizens can employ is to have money in either a tax-free savings account or the first-time home buyers plan, or both, and also at the same time have funds in a taxable account that isn't part of any of these registers account, so that these funds are all going to be subject to US federal tax at various rates that are generally lower than Canadian. But in Canada, only the taxable accounts would be subject to Canadian tax, and those would be taxed at, say, higher rates. So if you had your funds split between the two, and let's say your average tax in Canada is 40%, and let's say your average tax in the US is 20%, well, yes, you're paying 40% tax in Canada, but you're only paying it on one half of the funds you've got invested, because the other half are in these tax deferred accounts. And you take that 40% tax and you use it as a foreign tax credit against the 20% rate in the US. But remember, the US 20% rate is on all of the income. And so if you were able to model and structure it that way, the 40% tax you pay in Canada can offset the 20% tax on the entire amount you invested. You probably wouldn't have any US federal tax payable. Again, in general terms, you've got to model it out. You got to consider the net investment income tax, but that's a kind of strategy that one might employ there.
Yeah, and also one clarification is for the US taxation upon withdrawal from the tax-free saving account, the home buyer tax-free saving account is due to the fact that the original contribution to it is not tax deductible for US tax purpose. The withdrawal is also not taxable for US tax purpose. It would be essentially treated as a regular investment account. The money you put in is not deductible. The money you take out is not taxable. They just tax whatever income earned inside of the account. So with the modeling or whatever the strategy Steve just mentioned, that as long as you kind of model it carefully, then you're likely not going to be subject to any US tax throughout the year holding that account.
Sounds great. I'm just looking at the time here. Gina, we have time for one more question.
Okay. Was there any hint as to whether capital gains tax rate in Canada will be changed in the future?
Let's both answer that one. Philip, why don't you give your opinion on that first?
Yeah, so I have keep hearing all those rumor or discussion about potentially increasing the capital gain inclusion ratios for a long time. It seems like everybody talk about it for every single budget, but seems the federal government is still pretty hesitant of increasing it. But to be honest, like as the tax practitioner, we have really no insight on whether or when the government is actually increasing the inclusion ratio. And also for those that is not aware, is currently there is a 50% inclusion ratio for any capital gain. So if you have a capital gain of $100, only 50% of it is taxable. So $50 got added to your taxable income. So there was some discussion whether it's going to be increased to 2/3 or 3/4. There are a lot of rumors. I mean, to be honest, from our perspective, we have no idea whether it's going up or not.
It's a difficult one to predict. In the last election in Canada, the NDP, as part of their platforms, had a proposal to increase it from a 50% inclusion rate to 3/4. As many of you are aware, the NDP are now in a agreement to work with the Liberal government to effectively get a majority in Canada. Time will tell if the NDP have enough influence to make changes to this. I think we've always got to be mindful of this. I heard a lot less discussion on capital gains tax rates this budget cycle than I did the last two. So while it may not have as much momentum, it's always present, and we've just got to be mindful of how that impacts our portfolios and our planning in the future.
Yeah, I think, Steve, like the taxpayers just have to be aware. Nobody's going to know how the tax is going to change for the future. If they do have a significant, maybe a transaction that is significant enough, if they could fast track some of the transaction to take advantage of the 50% inclusion, yeah, go ahead and maybe consider that, whether that makes sense, right? Otherwise, for a regular taxpayer, I mean, just carry on and just deal with it whenever it got increased.
Sure. On that note, we're gonna end the webinar and the presentation. Again, we thank you for your time today. We appreciate that you're able to join us and hear our quick thoughts for last week's budget. And again, we ask you to complete the survey, and we'll have future webinars. So thank you again, and thank you, Philip, for joining us.
Yeah, thank you for everyone, and thank you for Steve.